We do. So that's a great point. We do that every week. And so I've got 25 weeks of recorded presentations. And that's one of the pieces of the reboot that we're going to be doing, is being able to share that in a much better way than what we've been doing.
Okay, I'll just dive in. And I have 15 minutes, correct?
Correct.
All right, just to preface, I could spend 2 hours on this topic, so I'm trying to condense as much as I can into this. So excited to hear everyone's questions afterwards. But I'm going to be talking about microacquires. So I had this crazy idea to see if I can help startups sell through a marketplace, and it's actually working. And so I'll describe what I'm seeing and maybe give you guys some tips on how companies are acquired, regardless of your stage. But essentially, MicroAcquire, it's a private, anonymous SaaS M&A marketplace. You can list your company privately. Helps, if you have employees, customers, and you don't want to have, the world know that you're looking for a potential buyer, we enable you to do that. A little bit of background on me. This is a really cool photo. I have built and sold 2 different companies. I have also a graveyard of other companies that I've started that didn't make it. I'm mostly known for starting a company called Business Apps. I started that in college, grew it from 0 to over 10 million in annual recurring revenue. And that was acquired by a private equity firm in 2018. And I only raised 100,000 for that. So I bootstrapped the whole company, technically. We were on Inc. magazine's fastest growing companies. My mom's really proud of these awards, so I have them in my house. And then after this, I started another company with the mindset of building it to sell. So after Business Apps was acquired, I started another company, which was acquired within, I believe, 365 calendar days. It was like on the anniversary of this acquisition. So I have a good amount of experience on the sell side, and so now I'm helping on the buy side as well. So when I think of startups, just being realistic, most of them don't make it, and that's okay. And so what MicroAcquire tries to do is really help startups increase their chances of being acquired. And these are, some statistics that I've pulled of just, how likely is your startup to be acquired based on how much funding? There is a caveat here, though. The more funding you raise, the higher the bar gets in terms of what you need to sell for to see a successful outcome or acquisition, however you want to define that. And so the problem that I'm trying to address is there's literally hundreds of thousands of startups being created probably every single day. Many of these are really, sometimes just lifestyle businesses. I work with a lot of startups doing 50K a year all the way up to a couple million a year. They're serving a small niche market. Most of them are bootstrapping. They're avoiding venture capital, which I think is an interesting trend as people begin to create more startups and understand that, the venture route might not be the best fit for your business. And just the reality, many startups run out of money or they never grow to an exit. And I'll talk about why they never grow to an exit in a little bit. But it's difficult to find a strategic buyer or financial buyer. Some of these startups are just not growing fast enough for venture capital. And so their exit optionality is pretty limited. And so I created an online marketplace for people to buy and sell these different types of startups. And the main question is probably, why don't startups get acquired? So most of the acquisitions you probably read about from Google, Facebook, Apple, whoever, that's a strategic acquisition. That's when a big company says, hey, this product or service is going to be a key part of our strategy over the next year. We're going to pay 30 times top line ARR or something like that. Unfortunately, for 99% of startups, that's just not the case. A lot of founders think that just, hey, I'm going to sit back and Google's going to come to my door with a big check. I won the lottery. That's just not how it works. And also strategic acquirers, they generally want to see a strong amount of product market fit. And from, the data that I was able to pull, that happens around 5 million at a minimum. And then traditional private equity, this would be your saltwater, ESW Capital. There's a number of different other PE firms. They want to see 10 million in revenue as a minimum. And then acquirers are pretty rare. They lock founders in for 3 or more years, so they're not ideal. And so MicroAcquire was just created to help more SaaS businesses just have an option to exit if that's what they choose to do. And just the easiest way to think about this is you have angel lists for investors. MicroAcquire helps you find buyers. And just some glowing reviews from both buyers and sellers that I work with. Some of these numbers are outdated. MicroAcquire has grown to about 25,000 users. We've done over 50 million total deals at this point in time. And again, the goal is to just help startups get acquired. This is probably one of my favorite testimonials. This was just an individual that listed his startup and it was sold within 2 weeks. It was a pretty aggressive process that he ran, but it's always nice hearing these things from founders. So this was a startup that was making, I don't know the exact numbers, but under 6 figures a year, and he was able to find a buyer pretty quickly. So here's the stuff you guys are probably most interested in terms of, you know, like who makes these micro SaaS businesses? What do they sell for? So based on the number of acquisitions that I've seen about 100 plus so far. So for companies that are doing less than 100,000 in annual recurring revenue, the multiple that I see on those businesses is 3.21. So the average annual recurring revenue is 21,000. The average sale price is 70K. You'll notice that's actually higher than acquisitions between 100K and $1 million, and then over $1 million. And the reasoning for that is it's safe to assume with a startup under 100K, it's a one-person shop, most of it's profit. So most of these profits are trading, or excuse me, most of these startups are trading off EBITDA or seller discretionary earnings. But using top line ARR is just the simplest way for me to show you these multiples. And the profile of buyers is entirely different than what you'd expect. So I'll dive into that in a little bit more. But you'll see people really do buy startups doing 1 to 2 million in revenue, 200,000 to 500,000, or even less. And that's really interesting. It's this new profile of micro SaaS or micro PE that's kind of emerging. And you may look at these and think, man, what's the fun in selling a company for $2.5 million or even $700,000? But the reality is I also speak with founders who have, this is a real example. Founder got to 2.5 million annual recurring revenue, had raised about $5 million, had an all cash offer at about $7 million, wasn't able to take the offer because if he did, he'd walk away with $300,000. So a lot of people in tech feel that people who don't raise venture capital, they're just not building big enough businesses, they're not thinking big enough. And in my opinion, it's the opposite of that. These are people that have really figured out to maximize your result. Equity is everything. And so if you have 100% ownership of your business and you sell for $1 million, I think you're going to be a pretty happy individual unless you're trying to be like Bill Gates and fly private and stuff like that. So these are amazing life-changing outcomes, but you're not going to read about this in TechCrunch. You're not going to read about this in Fortune. But this is kind of the reality for 90% of startups, and that's who I'm trying to help. So talking about selling. So how does this happen? Does someone just walk up and click buy it now and MicroAcquire and, boom, you're acquired? Short answer, no. It's a little more, there's process into that. Common mistakes I see when selling. So the first one would just be too messy. The company is losing money. Maybe there's limited information on the business. There's not enough to value the business. This could be for a number of different reasons. Maybe the founders aren't serious about selling. Maybe they're just not able to get everything together. And most importantly, there's no clear path to ROI. So you have to understand, why buyers will pay, say, profit times 2 to 6 or top line 1 to 3. It's essentially what they're doing is buying an asset and they're looking to see a return on that investment over the course of 4 to 5 years, or even sooner if you're able to grow the asset. So this isn't Google that can buy it and then write it off if it doesn't work. So it needs to be, there needs to be a clear path to ROI. And if you're just not able to see that, the company is losing money. It's going to be really hard to have that company acquired. And then I just alluded to the second point, too expensive. Founders tend to think, hey, I got to, $1 million in revenue. This thing must be worth $10 million, but we're losing 500K a year. That's just not how companies are priced in this range in the market from what I've seen. So typically, the clear just ballpark ranges of a startup that is in these numbers that I'm describing is EBITDA times 2 to 6, or top line ARR 1 to 3. And then there's so many reasons, so many mistakes I see founders when selling, but these were just kind of the main ones. I'm probably going to go over on time, but too difficult, lots of bugs, issues, crowded cap table, meaning you got to get approval from 20 different people, and then just unrealistic expectations. Like you're going to have a 2-week due diligence period. There's going to be no documentation of how the IP or the code base works. But really it just comes down to not preparing for an acquisition in advance and not starting acquisition conversations early with buyers and really creating that relationship. In terms of the acquisition process, if you wanted to run one yourself, this is kind of what it looks like. So you prepare, so you document everything. You get your company sale ready, so that means creating a data room, going through a due diligence checklist, recording how does support work, how does operations work. Anything I need to know to operate your company, you should record that and document it, and then determine the terms and the timeline. When are you selling it? What is the process? And then you start conversations, and that would be typically through micro-acquire. You would see private equity investors, just regular angel investors, a lot of executives too, CROs, VP of sales, VP of marketing, entrepreneurs who have maybe successfully exited a company and looking to operate a new business. And then from there, you go into negotiation. So this is when all the fun stops and you get into the stuff that isn't the funnest, but it's a necessary process. NDA, LOI, is it an asset purchase? Is it a stock purchase? What are the transfer terms? Are you going to stay on? Are you going to stay off? Is it a 90-day transition? Is it a 12-month transition? When are you going to close? That's probably the biggest one, at least always it has been for me. If you say we're going to close on a certain date, I'm going to hold you to that. And then you go and do due diligence, and that's basically a review of everything and then some. So it's kind of like if you were to sit down with your spouse and tell her every bad thing you've ever done, including has anyone sued you? Is there any security breaches that have happened in the past? You're going to go through all contracts, all NDAs ever signed. And those are called disclosures. And then if everything goes well, you've signed the APA or the stock purchase agreement, transfer the assets, they transfer the funds, and then you have officially closed when the company has been acquired. So that's just one example. There's tons of variations of this. There's no one template for this, but in terms of common buyer questions, typical ones you could probably think of in advance, but the biggest one is, how are you justifying your valuation? If you're just going out into the market saying, I think this is worth $5 million because I spent 2 years on it and just some random reason. That's just not how these buyers operate. How many customers do you have? How are you acquiring customers? What is your trailing 12 months revenue and profit? And then really, why are you selling? That's probably my biggest one. What is the reason behind it? So the more you prepare in advance, the better. Creating an organized data room helps. You can see this is just, you can create this easily in Google folders. Go over your metrics, document your infrastructure, document your financials, your team, operations, everything. Everything you possibly give to a buyer so they understand the business and literally just have the keys and take over from day one. That's going to make a buyer more interested. And then in terms of acquisition terms and timeline, for those of you that have raised venture capital, this is sort of similar, but I recommend founders run a process like this. If they're looking to sell quickly and they have some interest from buyers that they've previously created. So you can create a gated process where, by November 1st, we're gonna, book deadlines for, a briefing call where we just introduce the company to you. If that goes well, then you grant them access to the data room after signing an NDA. And then by December 1st, you're asking for soft offers or indicative offers. And that really is just people saying, hey, we're interested and we're going to finalize terms, and you do a little bit of negotiation feedback. And then you set a deadline for a formal offer in the form of an LOI by a certain date. So that would kind of be getting all the buyers and giving them a reason to make a decision rather than just sitting and waiting and essentially wasting your time. Because usually acquisitions, there's a saying, when you have one buyer, you have no buyers. And so you want to create a catalyst for giving buyers a reason to actually move forward on acquiring your company. And the best way to do that sometimes is to put them down a timeline and have a clear process and get people, if they're not interested, or if they aren't interested, you get them out. If they are, you keep working them, and that leads to acquisition. And then just clearly stating the objectives of, what you're trying to sell your company for. This one's a little counterintuitive, but I see a lot of founders that do this weird dance when they're trying to sell their company, like, we're for sale, but not really. The price has to be great. Like, just don't do that unless you're growing like Slack and you have like, like TikTok. Everyone wants to acquire them. They can do that. For 99% of startups, if you're looking to sell your company, it's better to just say you're looking to sell. Like, I'm looking to sell my company. Here are the reasons why. We put together a high-level overview of what we do, high-level financial numbers, nothing that's going to, harm your company if shared, publicly. But obviously, NDA sign, that sort of stuff. But just be clear and articulate what you're trying to accomplish, because these types of buyers look at hundreds of deals a month. That's their full-time job, because they're just looking to acquire companies. So this is just one example of an actual real slide from a startup that sold. And how to get started with MicroAcquire, it's pretty simple. You create a startup profile, and then I work with startups really hands-on in terms of, hey, you should probably, go through this due diligence checklist. Hey, do you have a P&L? No, your company is not worth, $10 million with 100K in revenue. That's probably the least fun part of what I do. Then they go live on MicroAcquire, and then from there they get to choose which buyers to engage with and then which ones to not engage with. And that's kind of it. I hope I was good on time, Taylor.
That's fantastic. Yeah, that is perfect. So we've got some questions in the chat that were coming in while you were presenting, but right now it's basically open mic and kind of open Q&A time. So Andrew, if you want to take a look at the questions in the chat, and then if you put a question in there, feel free to unmute yourself and explain or give some context behind it. But I think maybe the first question that came in was from Jeff Holman. Jeff, do you want to unmute yourself, because you asked a couple of questions, and maybe you can just kind of throw those at Andrew and the group.
Sure. Yeah, no, thanks, Taylor. And thanks, Andrew. This is great information. It's really fascinating to see. So my questions, just two simple questions, I think. Is there a strategy behind people wanting to build this smaller size of SaaS company? Or, because you always hear about the big successes, and it makes you wonder, are people setting out to build a big success and they just don't get there, so they end up selling a smaller company? Or are they or is there a strategy behind building and selling smaller companies to grow wealth in a different way? I'll leave it with that one.
Yeah, that's a great question. It depends on how you look at it. I mean, if you look at what startups do statistically, and it's a big echo. So you have a 1.78% chance of becoming a unicorn. So you have a 99% chance of failure. So with that in mind, would you ever buy a house if you knew that house was going to go to absolute zero? Probably not. So I guess my view is twofold. I think our tech, the startup ecosystem as a whole has minimized these sorts of outcomes as failures. Like, you sold your company for $5 million. Like, that's awful. What happened? in reality, that person's a millionaire. And in my opinion, that is a raging success, and I want to see people celebrate that more. I've also seen the other side where, they just raised venture capital and it's really not a venture funded business. And now they're stuck running the business essentially forever to basically pay back their investors. So, there's both sides to that story. There's, incredibly smart entrepreneurs that have looked at fundraising as, hey, I want to bootstrap a company and own this thing outright. And if I sell this thing for $2-3 million, I'm going to be thrilled and I could probably retire off that. And then, some are on the other end that you're describing where, they had aspirations to grow bigger, but then over time, it kind of becomes apparent that growth is leveling off, that maybe they want to move on to something new. They're getting a little bit tired, but they still get to see, an outcome that typically is better than, most venture-backed ones. Because if you have like 3 co-founders, you've raised 3 rounds of financing, you sell for $50 million, do the math on that, he's just walking away with maybe $1 million. So it all just depends on how you are looking at success. If you're swinging for grand slams, yeah, it's a failure. But if you're okay with a single or a double, it's a raging success.
Thanks.
That's a great point, Andrew. Just one note there, Jeff, like our focus right now is exactly what Andrew just described in terms of singles and doubles. So I'm working on a project right now that has less than 500 potential buyers or customers. I know that's the case. I know it's not going to be a wildly scalable business, but if I'm charging $20,000 to $50,000 in a software license to a few hundred clients, that's fantastic with me. So it is a strategy for us for those singles and doubles. So Andrew, I think I love what you said about that kind of Moneyball type model there.
You want me to just go? I can
Yeah.
rapid fire these questions. These are all great questions, everyone. Thanks so much for putting these in here. So Ben, is there a common profile or attribute of success buyers to date? Would you be referring to just who are they?
Yeah.
Okay, definitely. So there's definitely some serial buyers on there that I would put as, let's call it micro PE. So when you get over 10 million in revenue, your buyer pool expands and deals become much more competitive. That's where the multiples go up. That's where 10 million in acquisition land is the magical number where you start getting a lot of interest from much larger PE firms. And so what I've been seeing is this emergence of micro PE. So companies and firms that are specifically looking at assets lower than $1 million in annual recurring revenue. So it's private equity, it's individual successful entrepreneurs, and it's also strategics as well. There's a number of CEOs of companies that you would know in Microquire that surprise me every day. The first acquisition that we did was from a CEO that I respected. I've met the co-founder of BigCommerce through Microquire, which is just really cool. So to answer that question, it's kind of everybody, but looking at a smaller scale. The corp dev of Google isn't in there, and the head of Vista Equity Partners isn't in there, which is the largest PE firm in the world, I think. And then moving down to what ROI or IRR should a company be shooting for to be attractive as a buyer. So typically in venture capital and in private equity, IRR is put at 40%. So that is going to be modeled out by the buyer in terms of, can we grow this thing or can we reduce expenses, make it more profitable and hold it? And that's how we're going to see our ROI. That's typically the 2 paths of ROI from a buyer is, can we grow it? And then if we double it, that's how we get the 40% IRR. Or is there ways of reducing certain expenses to make it more profitable to increase the IRR? But 40% is kind of the standard, and it's also the same in VC as well. But 20% is beating the market, so you can find some pretty attractive deals if you know what you're doing. From an IP perspective, what's your guess at the amount of devaluation, if anything, ascribed by a buyer to a target company that doesn't have clear records at the start of due diligence? Really, so what I see mostly, it's a very financial transaction. So typically, revenue is really what is in focus the most. But also there is a clear understanding amongst buyers that look at companies at this stage that data is just not going to be, it's going to be messy data. There's going to be months where in 2016, this is a real scenario where, we didn't have our billing system set up and we were collecting through PayPal, Stripe, and this other thing. And so we don't know what our, customer or lifetime value was for this cohort. So, it's just kind of like to be expected as a way to put it. But I would say not too much. Really, the numbers that are most important is trailing 12 months revenue and trailing 12 months profit. That's what's going to be in focus the most. And then historicals, the more you have, the better, but that's going to be in focus typically the most. Based on your experience, I love this question. Have they mostly been fintech startups in the US specifically? So I like the second part of this question the most. So I see a range of everything. It's, MarTech, some fintech. Fintech generally has this sort of, they need to raise money to get over the, it's costly software to develop.
Yep.
So I don't see too much fintech. I have seen some, but nothing pops to top of mind. But surprisingly, most of the companies that I work with, I would say over half are in Europe or in some other region of the world. And that's been attributed to just the lack of funding options for these other startups around the globe. They just can't raise funding as easily as you can in the US. And so they're forced to build a profitable, sustainable business from day one. And it's been really interesting to find that out.
Right. But which has been like the top two industries in your experience thus far?
Top two, lots of tough questions. Like kind of everything, like CRMs, WordPress related stuff, server infrastructure monitoring tools, a push notification platform, SEO
Right.
platform. Like it's kind of the Shopify apps. Basically, I'm gonna go with everything on that one.
All right. Okay.
Do you have shared templates of any of the due diligence or data room documents, like a checklist? I do. So if anyone is, curious, you want to shoot me an email, I have all this stuff documented, and I do share this with sellers as well. So I focus most of my energy on the sellers. I built this for founders, not for buyers. Buyers are good. Like it's the founders that there's not a lot of information or education around how do I sell my company? Like what is due diligence? What do buyers want to see? And so that's the side of the marketplace I spend most time with is the founders. So I do have a full due diligence checklist. I do have a templated data room if anyone wants access to that. I can literally just duplicate it and you can change the slides. It has just blank information in it essentially. Does Mike require due diligence on these companies? Is Mike require acting as an agent? Great question here. So I will talk with the founder, and within MicroAcquire, you can connect Stripe, you can connect ChartMogul, Barometrics, Profitwell, Google Analytics. And so I can get a real snapshot of the health of the business, but I'm not a broker. I don't take commissions on any of the sales. I recently rolled out our premium subscription model, which was really to address the issue of startups getting too many requests from buyers. So for like $290 a year, you get early access to deals. I rolled it out literally last week. Just do the math on that. Like that's going to take me forever to make money. But the idea was, let's weed out some of the non-serious buyers over to the serious buyers. But no, I'm doing this for free. Obviously, there is an expectation on the buyer's end that you want to go through due diligence properly and evaluate the company. I do have services that I recommend. So if a transaction, like a buyer comes to me and says, I'm interested in this company. I say, speak with that company here. They can help you with due diligence if you're not familiar with the process. But to answer your question, no, I'm not a broker. I'm not taking commissions. That's also something I'm trying to help with the industry is, if you build a company this far, the last thing I want to do is take, 10, 15% like some brokers do.
So that's for me. And so you're not licensed. Is that correct?
So since I'm not taking commission, I'm not a broker.
But you have done some due diligence. And do you give guidance on multiples? Because you seem to have shared some multiples with us in this presentation.
Yeah, so I'll give some guidance, but in terms of the actual negotiations or, walking an actual buyer and seller and helping them figure out the transaction, the only role that I play is I connect the buyer with the seller, and that's it. Does that answer your question?
So what is your revenue model? I didn't really understand. If you're doing this for free, or you have a premium subscription model now that's not economically or financially viable, what is your?
That's it. That's probably a question I get from founders all the time is, why are you doing this for free? And so over time, I think I'll roll out different revenue models, but right now I just have, for $290 a year, you can have early access to deals ahead of the 20 other thousand buyers on the marketplace.
And your subscribers are who?
Anyone from a private equity firm to a CEO of a company, successful entrepreneurs. There's a pretty wide array of buyers. Cool. I'll keep going. Anyone else have any questions on that? Cool.
I think we're all dumbfounded a little bit, Andrew. We don't have any questions. That's a very long game. It's cool. Yeah, it's pretty cool. Yeah.
I know, honestly, one of the questions I get frequently, just to go back to Sarah, is, why are you doing this for free? I want to address that one. I know it sounds crazy, but, I guess I've gotten to a point in my career where I just want to get back to as many entrepreneurs as possible. I do realize I could, broker these deals. I could take a commission on these deals, but I simply want to help entrepreneurs succeed in whatever they're looking to accomplish. And this is my way of giving back, given that I've been through 2 acquisitions myself. I understand the landscape. And I basically just brought everyone that I know interested in SaaS acquisitions into one marketplace, and they get to transact meeting directly with founders instead of having an intermediary in the middle. So, over time that may evolve, but yeah, right now I'm just on a mission to help startups get acquired and celebrate these small life-changing acquisitions that you just typically never hear about and, are really, really hard to get done. And just going through the questions, will you be using MicroAcquire to sell MicroAcquire in the future? Probably. I don't have any plans to sell it, but I have had multiple acquisition offers, which is funny, but no, I don't have any immediate plans. My email address, just andrew@microacquire.com.
There are a couple above that, Andrew. One from Dale about guidance on factors needing to break through this micro SaaS stage of growth to avoid selling too early.
Yeah, so okay. Guidance on factors needing to break through this micro SaaS stage on growth to avoid selling too early. So, that's really just, focusing on growing your business. A lot of the founders that I work with too, they're just small teams. They don't have, they're not like a polished CEO. They're not, experience in building these businesses. And so they just take it to a point of, what they're capable of doing. And that's when they exit the business. Sometimes it's different, sometimes it's on the larger end, but specifically referring to the micro SaaS stage. I would say, just be passionate about what you're doing. I know that's a cheesy answer, but, that's always what gets you through the times when, you're at $1 million in revenue and you could sell it now. And I tell this to founders too. Like founders I'll talk to them and they'll say, hey, should I sell it or grow it? And I say, just list it on Microacquire because you'll get your answer, like that gut answer. Like, do you really want to, part ways with this company now? Or do you have a little bit more in the gas tank to keep growing this company? So I would say just make sure you're passionate about what you're doing, because I see a lot of entrepreneurs kind of get into something and they're just doing it for a commercial sort of return. And if you're not passionate about it, you're not going to put in an extra 10%. Someone's going to probably beat you. Cheesy answer, but I truly believe in that one. So was that helpful? Cool. Taylor, any other questions you think I should address? I know there's a
maybe the last one from Eric. Can you give a sense of distribution of deal sizes for startups? And then we'll shut down. I think we're about 7 minutes over our typical time, but it's been awesome to have you just blow through these questions. But yeah, if you don't mind taking a look at Eric's for the last one, and then we'll close up shop.
Yeah, so sense of the distribution deal sizes for startups you're working with, deal size or revenue size. So based on the numbers that I shared, so 56 startups acquired had less than 100,000 in annual recurring revenue, and that would be total deal volume of 3.8 million. 41 startups acquired with 100,000 to $1 million in annual recurring revenue, and that was total deal volume of 30 million.1. And then there's been 6 startups acquired with more than 1 million in annual recurring revenue. So the bulk of the startups are under $1 million in revenue. And I'm happy to share these slides too if Taylor wants to distribute them afterwards.
That would be awesome. If you don't mind sending me the updated version, Andrew, I would love that. Typically what we'll do is share them with the registered members of Midday Connect. But yeah, if you're okay with that, would love to get those slides, and really appreciate your time today. This has been fantastic. If you have questions, I guess I'm inviting on your behalf, Andrew, for people to connect with you on LinkedIn or otherwise. But if they've got additional questions, what's the best way for them to contact you?
Yeah, Andrew at microacquire.com, and I'm sure you guys are all working on startups, and I consider myself to have the coolest job in the world where I just get to talk to startups all day. So even if you're not like looking at selling and you just want advice on what you're working on, some go-to-market strategy, feel free to reach out to me. Happy to give feedback, hop on a call. Love to help in any way I can.
Cool. Thanks so much, Andrew. Thanks everybody, and look for some emails this week on the recording link and presentation link, and we'll see you all next Tuesday at 11 Mountain Time. Thanks, Andrew.
Thanks, Andrew.
Everybody. Thank you.
Thanks, Andrew.
you.
Have a great week, everyone.
Bye.